Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then. Yogesh Mehta of Motilal Oswal Securities and Avinash Gorakshakar of Joindre Capital joins us on the show. Thank you to both for joining me on the show. Today on Hot Money, we'll discuss stocks like TVS Motors, Hindalco, JSW Steel and PI Industries. The first stock that we want to talk about is TVS Motors. The counter has corrected significantly from yesterday's move. The numbers came in slightly below what the street was anticipating, and the management not giving any kind of guidance when they expect double-digit margin. That is something that added additional pressure to TVS Motors. That's the big question we're asking out. The numbers are out. The big question we're asking is, does this number give you confidence of accumulation in TVS Motors? So, Avinash, what did you make of the numbers and the management commentary?
No, in fact, Darshan, the numbers actually were much below what the street expected, especially if you talk the operational performance, especially on the EBITDA front. I think there was a big disappointment on the EBITDA margins, and I think commodity prices have risen, especially steel prices, and I think this has hit the margins quite badly. Going forward also, my sense is, improving the EBITDA margins is going to be a difficult task, at least for the next couple of quarters. So my sense is, I think, the price correction which is happening today on the stock would continue for a little longer time, because post-monsoon, how the monsoons pan out and how new product launches take off, I think the markets would be very keenly looking at the EBITDA margin number and obviously the volume growth number, because clearly, I mean, in terms of the margin mix, I think one has seen that the commodity prices, especially steel prices, have eaten into their margins, and the management was not able to actually give a comment as to whether they will be able to sustain these margins or there could be a pressure. So I would believe that, for the time being, it could be at best be a market performer. I think although numbers broadly look good, but in terms of expectations and in terms of our margin expectations, I think we could see a couple of quarters the stock underperform.
Okay, and what about you, Yogesh? What did you make of the numbers?
Yes, really disappointing. Though on the PET number it was very 5% beat, offbeat, but the EBITDA margin which sir has pointed that below 7% or estimated at 7% right now, and management is quite talking about the same thing about double-digit growth for last 6 odd quarters, but it has never happened, about the 10% plus. So there we believe that every time there is some reason that this time the raw material cost has gone up, or the price hike we could not pass on, and many other like auto expo expenses and other expenses have come. So that all gives some kind of ambiguity over the guidance over what the projection on the management's ability. So till now it was very much in line, but now it seems that the higher valuation at 20 times, 21 times FY20 basis, it shows that 18-19% growth is 18-19 times P multiple is also not supporting.
Okay.
So we have a neutral rating.
Okay, so the neutral rating, I think no bullish comments coming in from TVS Motors. We'll open it up for discussion. Yogesh, is it a case that the street is factoring in too much for TVS Motors rather than the company itself? Because the expectations are too high, the valuations that they have given is too high. So is it a case that the management is delivering, but the street is anticipating much more?
See, it was the same fashion for last 2 years, that people were expecting on a higher side and management delivered, but they've never delivered on the EBITDA margin in a double digit. So that has driven more on a disappointment side, and raw material cost and auto expo and all are routine things. It is for all the new business launch or any companies or in any industries. It is not that they are doing something new and which has come across. So there it gives some kind of red signal over there, and that's why the disappointment has come.
Okay, one of our viewers has written, Ravi Jagwani, saying that the management refused to give guidance in terms of when they expect double-digit margins will come in. Is it a clear indication that the management itself is not confident that it will achieve it?
See, Darshan, from what my understanding is, this management has never been very vocal with the analyst community. So, unlike Hero Motor Corp or maybe a Bajaj Auto, where the management interacts on a every quarter basis, I think TVS management has been slightly on the back foot. So, clearly, at least my sense is that you could possibly see the margins not getting into double digits at least for the next 2 quarters. So, the management not confirming it is a different point, but it seems that commodity prices are going to remain elevated at least for the next 3 to 6 months. So, that indirectly says the picture that margin expansion is really difficult now.
Okay, and Yogesh, I think the big rally point, and we saw the charts that came in, that TVS has been a marked outperformer compared to its peers. But do you think that, and that had happened because of the BMW tie-up that started, is it factored in now fully?
BMW tie-up and the production which has commenced, and now it is increasing also with the demand. So that has it is increasing gradually, but that all have been factored into the price with the new product launches they are planning for, the capex they have planned for next 2 years. So everything is already priced in right now at this valuation. Now people are, or the investor community would look at the new launches and the significant ramp up into the sales number on the monthly side. So there the production capacity of 3-wheeler is around 1.8, and for 2-wheeler it is around 2.5 to 3 lakhs. So there that demand is matching right now. So further uptick is requiring more capex of the new plant.
Okay, so that's the view that's coming in on TVS Motors. The counters down in trade post a weak number and weak guidance, and our guests do believe that valuations obviously is a bit of a concern, and the management commentary not the most encouraging. Let's start about the next stock, and that is Hindalco. The numbers were rather muted. No extraordinary number came in from Hindalco. The counters been rather muted, but the counters had a stupendous rally over the past few quarters. So the big question we're asking is the rally finally over? Yogesh, what did you make of the numbers, and do you think there could be more potential upside on Hindalco?
Numbers were almost very much in line with expectation, and we don't foresee that there is any significant disappointment, because ongoing, if we look at the future FY19, FY20 or maybe FY 2021, because it's a high capex cycle is on, and the demand is also increasing. Higher LME price is also supportive for this company in aluminum and copper. So that is advantage. Novelis is also doing very well. The debt which was there in Novelis is around now 47,000 crores. So that is also comforting. Near to EV to debt to EBITDA level, it is 3x. So which is in line with JSW Steel and Tata Steel and all. So on EBITDA basis, we believe that it is reasonable enough. And copper plants and aluminum plants ramp up of the capacity will boost further. And we believe that EV to EBITDA basis, it is still quoting at 5.7, 5.5 or 5.7 times EV to EBITDA. So that's a reasonable valuation.
Okay, reasonable valuation. And Avinash, what did you make of the numbers, and do you believe that there could be more potential upside?
No, I think Darshan, numbers were in line. I think the copper business underperformed, but aluminum business did pretty well. And I think as Yogesh pointed out, they are now in the midst of a bigger capex cycle. They have said in their management call that they are looking at a capex of roughly 1600 crores for FY19. I think the key positive highlight was the performance of Novelis. I think Novelis performed quite better. So consolidated numbers appeared definitely much better. But if one were to look at the kind of risk reward, I would believe that unless we see a further increase in aluminum and alumina prices, only then we could see a re-rating. As of now, I don't see the stock actually gaining traction in the very near term. Maybe over the next couple of years, hopefully the aluminum cycle picks up and prices move on. Then the capex which Hindalco is doing obviously will be benefited via volumes and pricing.
Okay, Yogesh, we throw it up open for discussion, because most of our guests, what Avinash is saying that he doesn't see much of a rally. But Yogesh, you seem to be you believe valuations are reasonable. Given the fact that Hindalco does a lot of hedging as far as its aluminium is concerned, do you think that could wane, because aluminium has rallied significantly, do you think that could also wane for the next 3 quarters on Hindalco because of the hedging that they've done?
Darshan, the hedging they are doing, when we spoke to the management, and they have disclosed into the management call as well, that for FY19 they've hedged hardly 30% of the aluminium and 30% of the copper. So that revenue they've hedged, and rest all they are not hedging right now. So they kept that bracket open. And they are quite optimistic about the LME prices and demand, as the demand is growing. So they are also in a vicinities that the price will also move up sharply. Or if not sharply, then gradually over a period of 1 or 2 years. So they are not hedging up to that extent like what IT companies does. So there is no, we don't foresee that there will be any significant threat, even if rupee is depreciating further on the INR and on the global side the LME prices. So there is not a threat on that.
Okay, it's not a threat. Avinash, you say that it will be range bound. You don't see it as the best play. Anything in the non-ferrous space that you like? Because if you take a look at the aluminium prices, Nalco is the most sensitive, while Vedanta is the least sensitive. Hindalco fits in middle. So out of the 3, which one do you think is a better bet?
I think aluminium will continue to do well, Darshan, but I think if you look at pure steel companies, numbers from JSW, I think were pretty solid. So I think the kind of management commentary we heard from the JSW, management indicating very clearly that not only volume but pricing is going to be very solid. Infrastructure, automobiles, appliances, I think these are clear sectors which are showing tremendous growth. So this could be a much better stock to actually look at if one were to look at the near term, at least 12 to 15 months, compared to an Hindalco which is largely global oriented. So JSW, my sense, would do much better than say Hindalco.
Okay, and that's the next stock that we want to speak about, JSW Steel. The numbers came out, very strong set of numbers. The management commentary was good, but surprisingly the counter has corrected today after giving strong set of numbers. So what's the outlook ahead? Will you look at this fall as an opportunity to accumulate? You spoke about JSW Steel. What did you make of the numbers?
No, I think very strong improvement in the operational EBITDA front, and I think clearly in terms of the margin as well as the volume mix, I think the management clearly hinted that automobile, infrastructure and appliances have been three key segments which have actually aided this kind of growth. In fact, the overall demand which they are looking at is over the next year is about 7 to 8% for the overall industry, and a 3% guidance which they have given for the next year. So I think despite the fact that they are operating at peak capacity around 90-91%, the management has hinted that they have made enough investments for the next couple of years to increase prices, do a lot of cost cutting. So I think eventually this is a company which I believe would obviously benefit from the upturn in the steel cycle, and obviously due to their captive nature and of for the raw materials and the cost cutting measures, I think we could see a better margin picture for FY19.
Okay, and what did you make of it, Yogesh, JSW numbers?
Of course, Darshan, the numbers are spectacular, and they have delivered much above the expectation. And PAT and EBITDA has given a strong beat. What we believe in JSW Steel, what we like is more on high OPEX and high CAPEX kind of a cycle, and they are showing a strong spread into the margins, and demand is also improving there. US is also doing very well here, and crude plus crude steel production is also growing right now, and the FY19 outlook they've given is also on a growth side. So putting all this together, basket mix, and the debt to EBITDA level again in this case also is less than 3 times. So that gives a comfort level and a growth leverage company. So it is always given a re-rating chances there, and we have re-rated this stock, and earlier our price target was 334, and now we have revised upwards to 394 now.
Okay, 394. So I think bullish views that are coming in on JSW Steel. In terms of Yogesh, there are input price caution. Firstly, do you see input price pressure coming in on Hindalco over the next few quarters? And secondly,
for JSW, for Hindalco?
For JSW Steel, sorry. And do you see that the EBITDA per ton was 11,950? Do you see this sustaining?
We see it sustaining, and even there is a price rise, it will be able to pass on further, because still they are very competitive in that part. And the demand which I spoke about, so EBITDA is around 11,800 odd rupees. So that is on the highest part. So sustainable over and above this time Q4 number is something which need to watch for, but it does not mean it will be lesser than that. Okay. But it will sustain at those levels.
Okay. You spoke about capex and coming in that way. Do you think that once this capex start coming in, is debt a concern for JSW Steel? Because debt will also increase given the fact once the capex.
No, definitely. In fact, Darshan, debt will obviously be a kind of a problem. But if you see, as what Yogesh mentioned, the debt to EBITDA is still comfortable, and the management clearly hinted that going forward, despite the fact that their capex is going to be around 35 to 38,000 crores, this capex would be comfortably be funded, and I think the target debt to EBITDA would be below 3 times. So I think as long as they keep this multiple below 3 times, the serviceable debt is definitely going to be something very solid and very comfortable and sustainable. So to that extent, absolute debt in number terms looks large, but if you see the incremental revenues which are expected to flow in from the revised capex program which they are doing, I think definitely net the company should benefit.
Okay, and we have a viewer query that's coming in. Rahul Kamdar is asking, is this the strongest play in the steel space? Which one is the best, Tata Steel, JSW, or JSPL or SAIL? I think these are the
I think whichever names you took, SAIL or maybe Tata Steel or JSW Steel, I would still believe that this seems to be a better choice, considering the fact that the leverage on the balance sheet is comfortably serviced by the operational EBITDA, and most importantly, the management commentary over the next couple of quarters is extremely strong. They are looking at a 3% volume growth guidance, plus overall industry growing by about 7-8%. 20%. And the fact that infra, automobile and appliances are, sectors which the company strongly services, possibly, the next couple of quarters could be as strong as what we saw in the fourth quarter.
Okay, and as a house, which one of the steel companies are you all most bullish on?
We have a strong, as a preferred pick is JSW Steel out of all the names which you have taken. And Jindal Steel Power is also there, but the strong, for pure on the steel side, it is JSW Steel.
Okay, so I think it's a consensus, yes, that's coming in on JSW Steel. The counter has corrected, no doubt, post the numbers, but our guests do believe it's a strong, price to start accumulating JSW Steel. And the final stock is PI Industries. One time, one of the most tracked mid-caps, suddenly the fourth quarter numbers proving to be very disappointing. It cracked significantly post the numbers, has managed to move up in trade today, but the quarter certainly was rather subdued. The big question is, we are asking, is there more potential downside? Should you accumulate PI Industry, or has it run up too much at this point of time? Yogesh, what did you make of PI Industries numbers and what's the outlook?
See, numbers were, say, subdued because of the weak demand and raw material supply issue with China. From the China side, and basically it was a logistic driven. So that deferment of that order has now moved to FY19 almost about 700 billion rupee. So that that is affected only for that temporary phase for FY18, but we foresee that FY19 will again be a very growth oriented, and we don't foresee that the same issue will happen because management in a con call they mentioned that many of the key issues they are addressing this time about new vendors. They have appointed 6 to 7 vendors to cut down that China dependency and all. So there they are working with the new launch, the new plant they are commencing from third quarter FY19. So first quarter may remain subdued, but the new plants at Jambusar again adjacent to that. So that will give some more booster to the growth.
Okay, and what about you, Avinash? What did you make of PI Industry?
No, in fact, Darshan, numbers were quite disappointing. If you see the third quarter number and the fourth quarter number, I think it's been a repeat of what happened in the third quarter also. So I think, I think clearly the markets were looking at a very strong operational quarter, especially from the CSM business, which has got a very strong order book. In fact, there the company suffered because of raw material issues, and on the agri front, the agro business front, I think they suffered because there was a problem with the GST and some weak demand in some consuming states. So my sense is one other weak quarter, and we could see possibly the stock underperforming. So I would prefer that it's better to wait for maybe another one quarter before we see normalcy of operations coming in, because the markets have already given it a multiple considering that growth has been factored in. So FY19 will be a crucial year, so it's better to wait and watch rather than buying it at current levels.
Okay, wait and watch is something that Avinash is saying. Yogesh, what's the target? Do you all have active coverage, and what's the target on PI Industries?
Yes, we do have active coverage on that, and we are maintaining our target at 24x FY20 EPS at around 954 rupees.
Okay, the management in the call had indicated that this was mainly on account of weak exports, and there was this logistical issue. Did they say this is like a one-off, or this could probably happen again?
No, they haven't mentioned on an intention basis that this may occur again or not, but they are taking steps to avoid such kind of a high dependency on this logistic issue and the supply from China. As I mentioned, that they have appointed 6-7 vendors into this for curtailing demand with the experienced vendors. So there they are very strong enough that probably 1 or 2 quarters we may not see. But with the capex which they are planning for, and the new plants once it commences, then we are also expecting that 12 to 13% of the domestic agri business is the growth we are expecting, and 18 to 19% into CSM business. So putting these two together, 16% CAGR over next FY19 and 20, we are projecting that will drive the growth.
Okay, so that's the view that's coming in, and Avinash, the management has guided for 18 to 20% growth. They see growth coming in both on the domestic front and the export front. Is this a fair number given what they did in the fourth quarter? Going ahead in FY19, do you think it's possible?
I think I would be more positive on the CSM business because it's got a very large order book and good amount of visibility. On the agri business, one good point which the management pointed was 2-3 new products are going to be launched. So obviously you're going to see traction from these new products. So I think probably after the first quarter number, as Yogesh pointed out, hopefully the second quarter of FY19, if it turns out to be a good, stronger quarter, one could see the stock actually gaining traction. But till then, I think it's going to be a market performer.
Okay, I think so. It's a mixed set of cues that are coming in from our guest on PI Industry. The counter today in trade is doing well. We're getting a lot of queries on social media. I don't know if you all track, but do you have a view on Praj Industries? Someone there is Ajay Desai who's asking on Praj Industries. I don't know if you track. Have a view on Praj?
I think Praj Industries. I think the only a near-term trigger would be the biofuel policy, which is launched, and I think here Praj could benefit. But operationally, fourth quarter was a weak quarter set of numbers, both top line as well as profitability coming down. So in case the investor has a holding, I think my suggestion is you'll have to give in some more time, maybe a couple of quarters before we see some sort of commentary coming in from the headwinds from the new bio.
Okay, and a query on ITC. I think you all track ITC. What did you make of the numbers? Sukumar Reddy wants to know how did the ITC numbers look?
ITC number were very much in line with expectation, and we had we have projected a decline into the cigarette volumes and all, but that has come below our expectation. So it is actually good. So that decline has not happened up to that extent, and we foresee that overall it is fairly valued the way we have seen consumer cycle and consumer sector stocks which are running at 45, 47, 50p some of the cases, but this is still hovering at around 11.5 to 12 rupees EPS, and for next year, so around less than 30 times. But that gives still FMCG hotter, and the paper business needs to be turned around. They are showing a flattish growth, so that needs to be watched out for the next 1 or 1.5 year. The upside seems to be very limited, so we have a neutral stance on that.
Okay, so upside limited, neutral stance on that. We're timed out. We have a management waiting by, but Avinash and Yogesh, thank you so much for joining me on the show. Muthoot Finance reported a strong quarter on the back of a diversification of loan portfolio. The company registered 40% jump on the net profit for the March quarter. To find out what worked well for the company and what's the road ahead for the next quarter, let's welcome George Alexander Muthoot, the MD of the company. Thank you, sir, so much for joining me on the show. In the last 4 to 5 quarters, the gold loan AUM has remained nearly unchanged. What kind of AUM growth are you targeting for FY19 for gold loans?
For gold loan per se, we would target something around 15% for the next coming year.
Okay, the performance on the asset quality continues to deteriorate, though it may not result into any kind of what did you make of the asset quality and the issues that are there, sir?
See, the gross NPA numbers compared to last quarter has actually come down. The percentage and the gross has actually come down. It is only the other NPA, which is the secondary NPA, which is, these are actually not NPAs, these are accounts on which the customer already has an NPA, but he has taken a new loan, and the new loans are actually only 1 month, 2 months old, but that is also technically seen as an NPA. That is why the gross NPA consolidated is going up. Otherwise, the primary NPA still continues to be less than what it was last 2 quarters.
Sir, how is your strategy of going door to door and approaching individual customers for recovery working out, and what GNPA number could we see by the end of FY19?
All the NPAs which you saw last quarter has already been closed, and the NPAs which you see now are the new NPAs. So these are just technical NPAs. We can actually go ahead, and if we auction these gold loans, the NPAs will become 0. But we continue to hold it in our books because we do not incur any loss on this. In fact, customers are also quite happy that we are not auctioning their gold. I can be rather harsh on the customers and auction all these golds, then the NPS numbers will be 0. But that is not what customers are coming to for a gold loan company. They need little more time, and we are giving them little more time, that's all. As we are speaking, the NPS numbers which you have seen there, more than 25% or 30% of those numbers are already gone off from our books because customers have come and taken it off. We do not need any hardcore collection for these NPAs because we already have the gold with us, and we are always in the money. That means the principal plus interest is always much lesser than what we can get by auctioning. So there is no point in being harsh and troubling the customers and auctioning these gold. That is why the company has taken considered decision to hold on to his NPS and be more customer friendly, because finally it is not resulting in any loan loss. Actually, loan loss for the company due to NPS is almost zero. Whatever loan loss we have is because of some frauds or burglary, which is only about 30 crores in the last 1 year. So it is just nothing on NPS.
So there's a large 57 crore other income component in the fourth quarter. Can you tell us what that will be?
Actually, the company had taken a insurance policy, a key man insurance policy, about a couple of 6-7 years back. So that the proceeds of that, which is about 30 crores, has come in to the company, and that is an income for the company, the key man insurance policy. The money has come into the company. That is one of the components for the high rise in the other income.
So what are the plans for the various subsidiaries? Contribution of the subsidiaries in the consolidated loan assets and net profit for FY18 is close to 10%. How meaningfully do you expect the contribution to go up by, let's say, FY20?
The contribution by the subsidiaries, which is the home finance, the microfinance, has been 5% year before last. And this year it has been little over 10%. That is what we had planned and what the company and the board had decided. Now, coming years, we would like to take it to 15% and by 20 to 20% of the book. So the subsidiaries are actually growing much more than the percentage-wise, because the base is small. They have been growing at 50, 60, and 65% in the last 1 year, and we expect the subsidiaries to grow at the 50 to 60% next year also. But since the base is small, the absolute amount may not be much. But overall, we expect that by the end of this financial year, the subsidiaries' contribution should be about 15% of the total asset book. And to answer your question, in 15-20, it should be little more than 20%. The subsidiaries are all doing well. We are also thinking of some venturing into some other related lending products, financial lending products like vehicle finance and personal loans also in the coming years. We are just considering it. So probably in the next 2 quarters, you will see some action on that front also.
Okay, Mr. Muthoot, we leave it at that. Thank you so much for joining us on Bloomberg Quint, and all the best for the quarters going ahead. With that, we're completely timed out. It's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.